Welcome to another episode of the Jon Gil Show. And on this episode, I'm super excited to have on my good friend, Ryan Cotter, here with me today. He is the market leader for Movement Mortgage, mortgage loan brokerage here in Chicago and in the country. Also the Real Estate Rumble founder, and an investor, an educator, and a philanthropist. So, Ryan, thanks so much for being on the show.
Always a pleasure.
Yeah, this is the second time you're on here, man. Yeah. We had a great time the last time.
Yeah, I think we covered a lot of ground. Put some good pieces out for people to, like I said, I really enjoy educating people on this stuff. Very passionate of it. So. Let's dig in. Let's have some fun.
Let's dig in. All right. Well, let's start with Movement Mortgage. Tell us a little bit more about the company and your role within that company.
So I'm basically like the one of the Illinois managers or area managers, and their story is phenomenal. Just the way the company was founded, their culture, what they speak of, and their consistent efforts to change the world. That is one of our mottos within the company. The 10 points is love and change the world. So we do mission trips to 4 countries where we go and we do work. We build schools. They have a number of schools that they built throughout the country. And the way the company is set up, it is 50% owned by a foundation. And so 50% of the profits go to charity organizations. So you don't hear that in society these days. I mean, it is
no, not at all.
Very, very unique for a large corporation. It's huge, right? I mean, we probably have 3,000 employees that have a mission to improve the communities that they're working in. And even communities outside the ones that the mission trips are to Guatemala, they're war-torn countries and in throughout the world, South America, Central America, Africa. So
that's awesome.
Pretty amazing company to work for.
Yeah, no, that's great. And I love everything that you're doing here. You're talking about the charities, so let's quickly go into the Real Estate Rumble. We're going to leave the some of the loan programs and everything here in a second. Trust me, we're building it up. But since to segue into the charities, you also are the founder of the Real Estate Rumble. Let's can you dive deeper into that?
Yeah, so that is an event where we have people from the real estate lending, construction industry, anything tied to kind of real estate, come together and put on some boxing gloves, lace them up, and punch each other in the face for a great cause. We donate the proceeds to at-risk youth programs such as Big Brothers Big Sisters, Mercy Home for Boys and Girls, GRIP on the west side. So anything that we can see that we can do to help organizations that have something close to my heart, which is, again, I think we go into a separate topic altogether about how we need to improve the city of Chicago.
For sure.
But mentorship is definitely number one on my list of children that may not have the proper people in their lives, right? So I believe that's a big thing, and the company movement fully backs my my charity initiatives, and it's just a great time. I mean, you get people from from our industry get together for this one night, and we raise a bunch of money, and we have a bunch of fun. The athletes, I will call them,
more or less,
get in great shape. It's all white collar fighters, people that don't. They don't box for a living. Their day job is something real estate related, and they donate their time and effort to this great cause.
Absolutely.
And it will be October 15th this year.
Okay.
At Cog Hill.
Okay, good to know.
Outdoor venue, just to make sure we're maintaining all the guidance that we possibly can within the context of still having a really great event.
Awesome. Well, I'm looking forward to that. Unfortunately, this time I'm not going to be punching anyone in the face, but hopefully soon I'll be able to do it. For the first time, maybe next year.
Yeah.
Okay. Okay, awesome. Well, great. So let's dive into then now, the actual products that Movement offers, right? We've got FHA, conventional, VA. Explain all the different programs that are currently on the table?
Okay. So there's a lot of the standard stuff where, like, I always tell people, like, I specialize in the complex and the construction, right? Because anybody can do a condo, anybody can do a single family. I find it that's why you have these organizations that are DDC, direct to consumer. So like the Quickens, like the Better.com, on those simple ones, like, it's kind of hard to mess them up. Right, they still do. Don't be wrong. It's amazing, but they're like, for somebody that's been doing mortgage financing for more than a couple years, you really shouldn't mess those ones up. What I really love is, like I said, the complex and the construction, and mainly multifamilies or something that needs value added to it. Right. So my background is in real estate development, so I have a unique lens of seeing something and telling somebody right away, that's a good deal, right? That's a marginal deal. That's a bad deal, right? And so what I try to educate my clients on that are going down that path, it's not for everybody, right? A lot of people just want to come home, take their shoes off, and be done with it. Like, I travel 3 days a week. I'm not going to deal with tenants or, try to rehab, a kitchen, let alone an entire building. So it's not for everybody. But those people that are interested and passionate about it, I want to be their one-stop resource for everything. I always tell my clients, like, listen, I've made all the mistakes, right? You don't need to make them. Have a question, ask me. I don't want you to fail. I want you to succeed. And you do that by, not always asking people, like, how'd you do it, because they'll gloss over it, right? So my question of anybody that I see that in a mentorish role for myself, and I have many of them, is I ask them, like, what was the worst mistake you ever made, right? I'm a big believer, like, I want to be the dumbest guy in the room at all times, right? I want to be surrounded by intelligent people. I want to ask nothing but questions. And those are the pitfalls, because the success stories, they just happen, right? If you know where to avoid, the successes kind of happen through hard work and just, planning. But, like, the pitfalls are the things you don't see that you want to ask, like, oh yeah, I remember this one time when I did this and this popped up. And as we can relate to, like, renovating, right? Like, we know that there's things behind the wall that we don't know yet, and we prepare for that, that contingency, right? Like, you're always looking at worst case scenario, and then you're padding it.
Yeah. Right.
And then sometimes you don't pad it even enough.
Yeah.
Right. But you're prepared for that. When we go into renovations, I always tell people, like, you're seeing these shows, you're seeing that they're all fake, right? On
HGTV. Make it look so easy, don't they?
It doesn't happen like that.
Right.
Nothing like that. And it was actually a really wise guy a long time ago told me, if your first real estate transaction is an absolute home run, it's the worst thing for you.
Wow.
Because you'll expect that, right? Now, if the first one's challenging or even, like, really difficult, and you still come back for a second one, this is the career for you. So I just kind of like, I prepare people, manage expectations that, listen, like, I make a whole bunch of jokes because I want to make it, still appealing without, scaring them away. So standard phrase is, hey, do you know a contractor that you can recommend? Absolutely not. Right? Because a good contractor, in my mind, because I'm prepared for it, is if they show up 80% of the time, that's an A++.
Correct.
Right.
Yeah, I know that very well.
Right. But you're prepared for it. Like, we're supposed to meet, like, at 10 a.m. Right? Yeah. Well, you just don't assume that. You do, like, what you did to me last night and today. Like, you text them at night. You call them in the morning. Hey, you on your way? Yeah. Oh, no, actually. Okay, I figured probably as much. So, when are you going to come? Right. And then you build that into your flow. You develop a flow because you can, quickly shift gears and know that the person that was supposed to meet you, again, 80% of the time, they're right on. This fell into the 20% of the time. I'm not going to get upset because still a good contractor in my book. I just got to move my time over here.
Yeah. And so with the construction, are you relating that to the FHA 203K loan?
So there's 5 different standardized programs within conventional and FHA. So we have the 203K has two different types. You have a lipstick and rouge type version, which is the Streamline, and then you have like the full on. I'm going to rip out everything and just start from scratch, which is the standard 203K.
And they're also capped at loan limits, right?
Correct. So whatever the number of units are, contained within the property, you have loan limits for that. So that includes like your acquisition and your renovation costs.
Got it.
I'll use an example of a 3-unit property. So if the FHA loan limit on a 3-unit property, whether it's completely turnkey or needs renovation, is $587, right? So $587,000. So if I found something that needed work, I have to get the purchase price and all the renovations underneath that number.
Oh, interesting. Even for the Streamline, because I thought there was a limit as far as like $35,000 per unit.
No.
Okay, so when it goes to that's what we're here learning, right?
So the Streamline is you're accurate on that. It's $35,000 total budget. So this would be something like if I found a single family or a condo that had a very outdated kitchen and bath that I wanted to quickly do a facelift. That'd be a great program for it. Okay. If I'm looking to like renovate a building, right, and I buy it for $400,000, well, I know I have $187,000 to make those improvements
on a 3-flat.
Okay. On a 4-flat, that's $729. Right.
Okay.
So I had a client. I have a number of clients doing this right now on 3 and 4 flats and reverse engineering it. So now that they knew that they wanted to do this, so they reverse engineered and I helped them do that. We're like, okay, so 587, 729. You want a 3-flat, you want a 4-flat. So now, depending on it when you're going through it, and you can do a quick assessment of like what I think is needed, that I can quickly underwrite the property, right? So when I teach clients this, I tell them like, you are going to go through properties, and what I'm going to teach you to do first is disqualify properties right away. Don't waste your time. And so I have them go into 3 buckets where it's it's an absolute great deal, it's a marginal deal, I got to call Ryan and we got to walk through it, or it's an absolutely doesn't make sense. I'm not even going to spend any more time looking at it. And so how we start this is with numbers. And so I always tell people, numbers don't lie, they have no feelings, right? So you look at the property, you get familiar with the market that you want to invest in, get really familiar with the rental numbers, because the rental numbers at the market, not just the ones on the MLS, the market rents will drive whether or not this falls into each one of those buckets, right? And the first thing that I want to teach you is that, this one makes absolute no sense. I'm not wasting time, because when people buy residential property, they're mainly buying it as single family home condos, right? This is investment paired with that. So if somebody's buying a condo or single family, the thought process as they go through is, number one, I'm looking at bright and shiny. I'm looking at pictures on the internet. I like that kitchen. I like that bath. Second thing is they look at the neighborhood. Okay, that's right down the street from my favorite restaurant, my favorite bar. Or those two. They look at those two first, right? And then the last thing that they're looking at, can I afford it? Right? So we retrain people to go numbers first, right? I'm looking at the numbers. That looks like a good deal. Okay, where's it at? Okay, that's close enough to my neighborhood. And then lastly, I'm looking at the property and seeing, do I need a standard loan or do I need something with renovations? Okay. And so quickly going through those numbers, and I make the joke about swipe right. I don't even know what that means. Really. I just mean that means got right. So swipe right and then look for those ones. And over time, it's a really quick training where with examples, so they can see, okay, that one makes no sense. That one makes kind of sense. That's a great deal. I need to move on that quickly. And I'll give an example of how this when you get good at it, like, you don't even have to go to the property, right? So I bought a building, and it's safe to say we're junkies. Right?
Yeah.
We're real estate junkies.
Yeah, absolutely.
Like, we just love it, and we just can't stop.
Right.
Because I had sold a building that I just finished renovating, had got a couple other rental buildings, always have a construction project, if not like several going on, but sold the building. And I was like, this was like Friday afternoon, closed on the building, had my son like 6 months earlier. So I was like, I'm just going to take a break, right? I just put some money in the bank and just take it easy. So, right. Saturday morning on the couch, grab the iPad, look at, found I was like, oh man, that's a great deal. Call up the listing agent. Hey, code is I'm an unrepresented buyer. I want to buy this. Would you represent me? So that code for like you're going to get 2 commissions.
Yeah,
right?
Exactly.
And so you're going to tell me what I need to do to get this property.
Right, exactly.
And she's like,
that's a golden nugget, by the way.
Yeah. So do you want to see it? I was like, I can. I mean, it checks all the boxes. Brick building, 3 flat, looks in great shape. It's priced right. Like, bring a contract with you when you show this to me. Wow. Yeah. And so, of course, I see it. It actually worked out even better than I anticipated, because I was going to do a 2 or 3K on it, and looked great. I was like, all right, what do we got to do? She's like, you got to offer $470. Throw in a $5,000 closing cost credit. And we'll be good. Like, perfect. Got it. Did it. Renovated, and again, a little bit more skilled, but renovated completely all the units in 60 days.
Oh, that's really good.
And then got it.
You got a good crew. You got a great crew, actually.
Then got it released, and it was kicking off $1,500 a month. And so this is kind of the, like, talk about golden nugget. This is like, so I always tell people, like, with those programs, if you can work in a seller credit towards closing costs, which I don't think is utilized enough, it's really tough in this market because properties are so hot. And what that kind of does, unless you can convey it correctly to the listing agent, who then conveys it correctly to the seller, is the best use of the money, period, right? Because, it's less money out of your pocket. So this example, I bought this $470,000 3 flat, got $100,000 to renovate it, just clean up kitchens and baths, right? Paired a seller credit in there, and then there was some inspection items that popped up that we were able to work out an additional credit. Then you get tax prorations. I bought that building with $14,000.
No kidding.
Yeah.
So $14,000 total out of pocket, and you're netting a month $1,400.
Yeah, $1,500.
Or $1,500.
$1,500 a month, and it was I did it all in 60 days.
Unbelievable.
Got $100,000. So in essence, just over 2% of the total of acquisition and construction costs. So I leveraged 98%.
Amazing.
Yeah.
Well, I mean, and that's what you teach, right? I mean, that's part of the whole program. And with FHA 203K, what are the main, because one of the two differences between the product Streamline and the full 203K is, I know that on the $35,000 or on the first one, which only is Streamline, you can only, from my understanding, you don't really need, it's not as heavy on the construction bids as, say, on the other one. So it's a lot quicker as far as closing time.
Right.
So what are the lengths? What are the closing times for each on average?
So there's a lot of people out there that want to do these loans, right? And there's a lot of loan officers that would love to get into the space. You need a really, really specific skill set. I always say, like, if a loan officer, from a loan officer standpoint, before you can do one of these loans for a client, truly effectively, you yourself have to go through the loan, right? You got to be the test case, right? So you can see all the nuances of what's associated with it. So before I did one, I'd seen them from all angles, and then when I did it, you're like, okay, now I can really show people how to do these very well. And then you just like keep on coming up with like little nuances where you get in for practically nothing. Okay, but the timeline in the industry is horrendous, and everybody's scared of these products, because what ends up happening is that people try these good intentioned loan officers, right? But you need a skill set, like you got to be able to see plans, you got to know budgets. Like, people will come in and look at a property and go, okay, yeah, $35,000, I could change out like all this stuff. Like, no, that's going to get you a kitchen and bath, right? That's not going to get you a renovation. That's going to get you lipstick and rouge,
Right.
right? So you got to know like what is even feasible, and most loan officers don't
Have no idea.
No.
Yeah, they're not investors. They're strictly just loan officers.
They're loan officers.
Yeah.
And so
Or just strictly realtors.
yeah. And so what happens in the industry, one of the things that I'm trying to change in a narrative, at least for at least within my group, we've changed the narrative, but within the industry as well, is that FHA 203K is a horrible product. It takes forever. It's a pain. They don't work most of the time. And I have high 90 conversion rates on 203Ks.
Yeah, well, we closed one not too long ago
Yeah.
on a 203K loan.
Yeah.
And it was great. The first deal I had under contract didn't go through.
Yeah.
And, we reactivated it. And then, when I saw the pre-approval come in from Ryan Cotter at Movement Mortgage, I was like, okay, this is done.
Yeah.
Let's this is going to be fine. And it was streamless. Or it was great.
So the industry average on a 203K, and we get into the reasons why a little even more, but is generally they think it's going to at least be 90 days, potentially like 120 in that close, right? I consistently can get them done in 30 days or less.
Yeah.
Because it's about the pre-planning and having the clients know what to do. I have checklists for listing agents like on these programs, and then I follow up and they're like, why do I have to do this? I was like, how many 203Ks have you done? This is my first one. That's why. Because we want these to run seamless, and it's not just everybody does what they're supposed to do on these transactions. It's a team effort, and so in the initial conversation with the listing agent, and we didn't have to have this conversation, but when it's somebody that I don't know, I have to have an interview process with them so that they understand this product. It's unique, right?
Right.
It's going to take a little bit more work on everybody's side.
Absolutely.
But if we all do what we're supposed to, and I'm going to quarterback it, and if you do it, we'll get to the closing table. The client will be happy, and you will get this property that. I mean, we have two of them. One was in a fire. One had. Just a long history of neglect on maintenance. But like explaining to the listing agents that I need you to do this. This is why I need you to do this, and breaking down the why behind it. And they're like, oh, that makes sense. I've never heard that before. Like, well, because number one, this is your rookie thing in it. And even when I run into one of the people that I'm working with right now is a 20-year veteran in real estate, and they're sometimes even the worst people to talk to because
I know exactly what you mean.
I've been doing this 20 years. How many successful 203Ks have you had? Right. I knock out a bunch of these a month. Right. So and it's like, okay, fine, I'll do it. And then halfway through the process, wow, you guys really do that stuff fast. I was like, he's like, I'm really impressed with you guys. And he's like, it was funny because I was just telling my team the other day, he was like, I'm having a card game on Saturday. You want to come by? I'm like, I got a 2-year-old and a 6-year-old,
right.
man. No.
No time, right,
No
right.
time. But it's so I know personally of a lot of loan officers that consider themselves renovation specialists. I've worked with them, and they're not. I mean, I had one guy that worked with me that, worked underneath me, and somehow I got a copy of the plans for this building that he was going to try and do a 203K on, and I'm like, that's not going to work. I was like, how do you think that's going to work? It's like, oh yeah, it's going to work. Like, dude, do you know how to read schematics? Like, you're talking about there's no way that budget's going to work. It's a 4-flat. No, yeah. And so I'll run into it and I'll talk to realtors, and they're like, yeah, this guy is considers him a renovation specialist, and everything is exploded on the launch pad every transaction we've done.
So what are the key questions that someone who wants to get this sort of program can ask to know whether that person knows what they're talking about? So
use the industry.
Got it.
Don't just go to somebody, because again, it's a program that's available to everybody. So saying somebody can do a 203K, and I'm an expert in 203Ks. I do a lot of these, do you want to go to a doctor and go, I just got my license and
Right.
I can
It's track record.
technically, cut you open and, and stitch up your heart.
Right.
I just haven't done it before, but I'm really excited about doing it. I want to do it. Like, no, you go to a specialist, right? So use the industry, get some referrals, have some conversations with them, and then, go that referral. Don't trust, an ad for sure.
Yeah, anyone can put a title on their name and, use it for marketing.
Could I get a couple of the clients that you have worked with in the past on 203Ks to give me a thumbs up or a thumbs down? Am I going to be like? And I would say like, how many referrals do you want? So my thing is like I know what I'm doing. I can tell you what not to do. Before you get too far in it, and everybody just hates each other.
Exactly. And you said that earlier, right? Which was you automatically say, we're going to retrain you. Mm-hmm. And if that person's not saying, okay, it doesn't start there, have some, be skeptical. Now, why would, so we know that FHA 203Ks and Streamlines are used for the purpose of renovating. Mm-hmm. Now, somebody just wanted to go in for an FHA loan, a strict FHA loan, what would you say to them? Because what if they just want to take the property as is?
Mm-hmm. Yeah. Just real briefly, the conventional renovation loans is called a home style renovation, and it's not.
This is not FHA. This is not FHA. Straight conventional.
Another one. They offer a couple ones that have higher price points and a conventional. But they require a little bit more money down. So there's more products out there, but we'll stick with the 203K because it's a really, really good one with very little money in.
Yeah.
To just a standard FHA loan where somebody wanted to find something turnkey, I would say that these are tools, right? And if all you have is a hammer, everything is going to look like a nail to you, right? So if you understand how these tools work, the FHA 203K and the FHA loan itself on multifamilies is a scalpel that you can use effectively, right? To get into the property with very little, funds on your side. Now, I'm not saying like you should be, have no money and try to buy one of these properties because we believe in, having reserves, having cushions, understanding contingencies and all that good stuff.
Yeah. And real quick, I mean, because one thing that I don't know if we mentioned was that the whole part of FHA products, one of the neatest things is that it's 3.5% down.
Correct.
Right? I mean, that's it. I mean, I don't think there's any other program out there that allows you to put as little down.
Leverage at that level.
Right.
With really good interest rates.
Right.
And 30-year fixed money. Right.
Exactly.
And you can use it to as a step, into even better financing, potentially. But even if it's not, that is still really good financing that you can just like hang your hat on. Yeah.
And the difference between, can you be, and is this for first-time homeowners? Is it owner-occupied buyers, investors? Who can use this program?
So the FHA loans are only for owner-occupants, right? So you have to live in the property, whether it's a 3-flat where you live in one and rent out the other 2, single-family home, you have to occupy it as your primary residence. The conventional side, the home style renovation has a owner occupancy piece, which requires only 5% down on single families. But when it goes to multifamilies or investors, which you can do those, it's 25% down. But again, 30-year fixed monies on 2 to 4 units, and you can renovate it. So it's one of the best products. And then on top of that is, just regular construction loans, like whether I find a piece of land. And again, I always tell people you want to crawl, walk, run, right? So later on down the road, if you found and you had that skill set and you knew you had a construction crew and all that stuff, you found a piece of land and you wanted to build a property, there's the construction loans, which we have access to as well. But that is for your absolute seasoned real estate developer / investor.
So, for example, I recently acquired a 4-unit. If I wanted to, it's an investment property. If I'm looking to refi out, would I be able to use the home,
home style renovation?
Home style, I'm sorry, not home style. Yeah, right. What sort of, well,
if you're refinancing to do construction,
Right, exactly.
you could. If you've completed the construction, like an example would be you found something, it was a 4-unit property, and you went to your most trusted bank, and they gave you construction financing. It was simple and easy, and you wanted to take out loan, right? With a conventional 30-year fixed mortgage, you could do that as well, and that's what we recommend because Fannie Mae and Freddie Mac will allow you to have a total of 10 financed properties. Okay. So, why wouldn't you get, if you're going down that path, right? 10 financed properties with nice long-term 30-year fixed debt. Doesn't make sense not to.
Right.
Right. And then you continue to build up your portfolio. When they say no, you can't borrow any more money from Fannie Mae and Freddie Mac because those institutions, their design was not to help investors, right? It was to help mom and dad buy a house, right? Joey buy a 3-flat, right, and live in one, right? But still the rules right now, right? So when they say no, you can't borrow any more money from these cheap sources, congratulations, you won, right? You got as much long-term cheap fixed money.
You're able to squeeze out all the juice as possible.
Absolutely, right? So that's a win.
Yeah, and the other, you have I know that there's another going into different strategies that you can use with some of these products. There's that 4-4-4-3-3-3-2-2-2-1-1-1. Can we talk about that?
So it's an offshoot of the 4-3-2-1s, and it helps to understand where the money comes from, right? Okay. So Fannie Mae, Freddie Mac, right? So they have these people called underwriters, right? And they are the gatekeepers of the money, right? And so for my 101 class is explaining the 4-3-2-1, which is you buy a 4-flat, right? Then you buy a 3-flat, then you buy a 2-flat, then you buy a single family. And how that makes sense is because an underwriter, the gatekeeper, will believe that you're moving from a 4-flat to a 3-flat, then from a 3-flat to a 2-flat, and then to a single family home. They will not believe you do it the other way. Like if you bought a single family home, I always tell people if you buy that single family home first, you shoot yourself in the foot because they're never going to believe, no matter how much it could make sense financially, that you're going to move out of a single family home into a 4-unit property. Right. There's always a couple exceptions to some rules, but as a generality, it's really hard to convince them that's going to happen unless you have already moved out of your house and leased it. You have your house on the market. There's got to be something. Like they're not going to believe you're just going to retain it and move into the 4-flat, but they will absolutely believe the other way, right?
Yeah, absolutely.
And so, for somebody looking to just do some passive income investment, that's the 4-3-2-1, right? And you don't have to do you just do a 4 and then a 1, right? Get one building, 2 buildings, and then your single family, whatever way you want to work it. The advanced MBA class, and this leads to crawl, walk. When you're doing this, you're jogging. So you buy a 4-flat, right? And I'm going to use an example. I buy a 4-flat for $500,000 to start off with because I have a strategic plan over the next 12 years to acquire 10 properties and put them in long-term fixed debt with Fannie Mae, Freddie Mac. So I buy my first 4-flat at $500,000, right? Live in there for a year like you're supposed to, and then I want to buy another 4-flat. Well, how am I going to convince the underwriters that I'm going to live in this other 4-flat? Well, the next one, I'm going to buy it $650 because then that's my story. It's going up in value. My cost per door or unit is more. It's in a nicer neighborhood. I got a garage. There's a story behind conveying that to the underwriter. Right. The believability of occupying it. Because if I occupy it, then I get it to using the low down payment program, right? And then the last one, I'm going to go all the way at the FHA limit of $725, right? And so that's my 4-4-4. Then I'm going to go to a 3-flat and do the same thing, and then move them up, explain to an underwriter, again, at some point in time, they could very easily say, you're denied, okay? But chances are you've acquired a bunch of properties before that, right? So you still win, right? You're squeezing, like you said, Yeah. And sometimes you're like, you're all out of juice, buddy, right? Yeah,
right.
So and then if you could do this, again, this is not a get rich quick scheme. This is a get wealthy over time plan,
for sure.
Because you're not you're living in all these properties, and you have to live in them for at least a year, and hopefully you've added value, and you're able to. There's a lot of nuances, but again, it's a master class that we're just breezing through real quick here.
Right.
So 4, 4, 4, 3, 3, 3, 2, 2, 2, 1.
And you can take advantage of.
And that's 10 properties.
That's 10 properties.
Yeah.
How many units total? About 27, right?
Yeah.
That's insane.
30 units, and you're
30 units total.
Roughly 30 units, and you're good to go. There's so many other like super cool sweet spots. Like I always tell people, look for a 4 flat with an illegal basement unit, the 5th unit, right?
Absolutely.
Right. That's a 5th unit. So you got a commercial property,
yeah.
right?
Well, and in the city of Chicago too, they're starting to allow
for the accessory dwelling units.
Yes, exactly.
Yeah.
Exactly.
I'm on the Greater Chicago Home Builders Association, and we were talking about this, and they have they're in with the mayor explaining because there's so many legal units in the city of Chicago, right?
Consisting of coach houses or basement units.
All that, right?
Yeah.
So they were
Attic
looking
units.
at ways of hey, this is just this is probably a problem just waiting to happen. Why don't we see if we can get this to be actually some form of legalization, right? And what I find in the industry as well is the wrong terms being used 100% of the time, right? So there's non-conforming. They'll be like, that's not the right term, right? Non-conforming means that at one point in time it was legal, it was conforming. So that makes sense, right? Conforming, non-conforming.
So you'll see legal non-conforming a lot.
Right.
So that's what you mean by that.
Right.
Okay.
And that's not accurate.
Got it.
Right.
So you don't say legal non-conforming.
So there's just legal and illegal.
Got it.
So if it's a basement and there wasn't like a permit pulled for it, and there's a unit in there, that's illegal. Okay. Non-conforming is that same situation where you have a legal unit, but the overlying zoning, right? Because the city of Chicago downzoned everything a bunch of years ago to basically kind of regulate developers from knocking everything down and building up brand new. Which there's nothing bad about that, but there's drains on city infrastructure, whether that's water, sewer, electric, and you see a street with a bunch of ripped up holes because they're bringing in new water and sewer lines, right? That's infrastructure, right? And we got a really old city with some really old infrastructure,
right?
So that's what they did. They downzoned everything. But your zoning certificate, the piece of paper that you get that says this is a legal 3 flat, should this thing burn down, right? You can build back a 3-unit property, even though the zoning right now is only zoned for a single family home, right? So RS3. So legal non-conforming would be that 3 flat that's currently zoned RS3.
Understood.
But then you have your zoning certificate that trumps the current zoning. Okay. So they downzoned everything from R4, R5 a bunch of years ago and on the complete north side because developers were throwing up buildings left, right, and center, right? Some of them weren't built as great, but they were built as of right? They didn't have to go through the city very much for anything. So the entire city downzoned it. And so you have to go back and ask for whether it's an upzoning, a variance, rear yard, front yard exception, any of those pieces. The city has their hand on it and can make sure they're watching you. Okay, so those terms I hear a lot that aren't accurate. Of this is a non-conforming basement unit. It's not a non-conforming basement unit. It's an illegal basement unit.
Right. Well, and so that's going back to the original point, which is look for the 4 units that has possibly an extra basement, that you can put in a
accessory dwelling unit. So now the city has
ADUs.
opened up that you can actually apply for it, make it legal, and make it comply. Now it's not a separate legal unit. So you had a 4-unit building with an accessory dwelling unit. You technically have 5 living spaces, but it's still not classified as a 5-unit property.
That's amazing.
Yeah. All these little like
Yeah.
gray area. This is shit Chicago, man. What do you expect?
Yeah, no, true. That's amazing. Now, okay, well, so yeah, now as far as the management is concerned, how, for 30 units, do you also provide any sort of kind of management help as far as letting them know, okay, well, here's what you can expect?
Mm-hmm. Yeah, I want them to be successful. And nowadays, management companies, they're a lot more affordable. You can watch them. You're not just hoping and praying they're going to collect. They send you reports, and you got accounts, and you basically are, you're deferring the management to an actual company that does it.
Absolutely.
That you don't have to get a phone call at midnight and deal with a clogged toilet.
Right.
You pay for it, but if the property is kicking off the cash flow that it should be, again, the whole thing is that somebody else is paying your mortgage on the property.
Yeah.
Right. In 30 years, probably a lot less because rents are going to continue to escalate. You're going to own it free and clear.
Yeah, absolutely.
Right. So it's a long-term play. So if you make your life simpler and make less money on a monthly basis in the future, who cares? Because you're going to own it free and clear.
Yeah, correct. The other point that I want to bring out is, we're talking about these loan products, but a lot of people are on the fence because of their credit. Maybe they don't have the best credit score. Mm-hmm. How do they, should they first fix their credit before they even start looking for loan products? Mm-hmm. Or, maybe there's just one late phone bill and, brought them down to maybe 580 credit score. Can they apply for these loan products?
So I would say first thing is obviously find
qualification process. Let's talk there. Yeah.
Go get qualified. Know where you're at. And people are like, well, my credit's not that great. And I give them hundreds of stories where, somebody told me I don't think I qualify. And then, I'm like, okay, what's your credit score? 640. You're fine. Right. Let's go. Let's get it going. Or my score is 595. I want to get it up there. Well, I just know your options because you could, because FHA will allow you to go to, that they will technically not, you don't even need a credit score, but your down payment might increase to 10%, right? With FHA, if your score is below, 580, right? But just get the information. Don't think you know anything.
Right.
Lack of better words. Talk to somebody who does know something, right? And a qualified individual that has referrals, and and you can get a few people to say, yeah, that person knows what they're doing. Because I'll find a lot of times that when I go through it, that if you don't know where you're going, any road will take you there. But if you know where you want to go, you'll find the path of least resistance. Point A to point B, right? And so we create roadmaps for people that may not be there right this second, right? Or people that are there right there this second, but they're just there by the skin of their teeth. Mm-hmm. And we say hey, we want, between now and when you get this property, we're going to put you into a credit repair program so that you can actually improve your credit. So by the time you actually find something, it's better than this, which is only going to help you out. Mm-hmm. So don't think all the details. You do a bunch of research, but really just get with that professional, get qualified, and know, do I need to be on we call it the home path, right? Do I need to be on a home path program where I need to improve my credit? I need to clean up some stuff. And then what's that time frame look like? Or am I qualified right now? Maybe not, by the skin of my teeth, mm-hmm. maybe a little bit more, but I really want to be this because I'm going to continue to improve on this and continue to buy property. So I really want to get my score up to the highest possible.
Absolutely.
As quickly as I possibly can, because it opens up more opportunities, more financing possibilities. So there's where you're at right now that we can see. And if you're not ready, right, for some reason, we have the resources to tell you hey, there's a bunch of credit repair companies that, you can just Google and just see who has, the highest ratings. They all have a charge. It's going to take, it's not an overnight fix because, sometimes it is. Sometimes nowadays with simulators, we can, in 30 days, we can get somebody's score up a ton. Some of them are longer term fixes. And, the world today, everybody just wants it right now. And, if I don't get it right now, I'm not. Well, okay, well then you're
not committed.
You're probably not the right person for this, again, because you need that, like you said, commitment. And whether it's commitment to improve my credit, commitment to save money, commitment to save money and budget, because this is what I want. And so we have an initiative going, it's called Grab the Key. And it is to educate the people in the underserved markets, the south and west sides of Chicago, of like these opportunities that are just like, they're ready. Like you don't have to be specially qualified for any of this. It's there. You just need the education and the guidance, not just to the closing, but past closing, because you're going to need some questions answered. And it's easier today than like when I started, right? Because there's blogs, there's
so much
Angie,
information.
so there's so much information that you can get whatever you need. You just got to be committed to wanting to find it and the drive to go get it. Because you can Google just about anything. You'll find a YouTube about just legitimately anything.
Yeah,
you can build they'll show you how to build a house from scratch.
Yeah, that's true. Yeah, just about anything really. And now, as far as the income is concerned, I know that last time we talked, you used an interesting formula that said, okay, well, if I make this amount of money, more or less, this is how much I'm qualified for. Mm-hmm. I think that was like 3 times your income, right?
So with today's interest rates, right, and that could change over time.
Sure.
So this is a definite.
Well, that's the variable
this
is
a definite, this time frame. So if you watch this, 5-6 years ago, 5-6 years down the road, when you're like you got your own talk show, it might be different.
Right.
But at today's interest rates, whatever you make on an annual basis, what you report to Uncle Sam, not what you believe you make. So I always tell people, like, how much you make? Okay, is that what's on your tax returns? Right? Like, I don't know. Well, take a look at those.
Gross or net?
Gross. Okay. What you report to Uncle Sam, if that's consistent over a 2-year period, right? And there's a lot of asterisks there because we can sometimes average them. But whatever you report to Uncle Sam, you could afford to borrow 3.5 to 4 times that dollar amount. So if you make $50,000, you can borrow almost $200,000. If you make $100,000, you can borrow $400,000, right? On a conservative approach, right? That's not even going high end, right?
And is that strictly for single families or units?
Single families.
Okay.
Now, when we add the rental income, which is a variable, just because you could have like a 2-flat with 2 1-bedroom, 1 bath. You could have a 2-flat with 2 3-bedroom, 1 bath. So we try to use an average, but I find that it goes to like a computation of around 7 to 7.5. So if I made $100,000 with rental income based on getting X amount, then I could borrow 7 times that number. So now I can afford a $750,000 multifamily. Right? 4-flat.
Yeah.
And so again, there's a lot of variables in there, but that's what I've seen a lot of times. When I've gone directly to the 4-unit property, right? 3-flat would be a little bit less, and plus you got the loan limits.
Right.
So a lot of like little details, but 4-flat, make $100,000, you're probably going to be fine with the loan limit. So usually when I see somebody that's making like $90,000 or $100,000, I go, you're typically going to be right at the FHA loan limit, because that's going to be the cap.
Wow.
Yeah.
On a 4-unit.
On a 4-unit.
Right. So someone who's making, say, $35,000. Let's just one quick last scenario. Someone's making $35,000 a year with a 650 credit score, has, say, the 3.5% down payment, or let's say they have $10,000 in their bank account. Can they qualify for
a $300,000 4-flat?
Okay, got it. Using that same principle.
Yep.
Okay, well, perfect. Yeah. There's a lot. That basically fills an entire majority of wage earners.
Yeah, absolutely. So you don't have to be. I'll use an example of one of my favorite stories. So I had this AT&T worker. I've told you about this before. So I had this AT&T worker come over to my house, was installing some just a phone line. And he's like, wow, it's a big house. I was like, you don't look that old. Like, how'd you do? I was like, I bought multifamilies, right? And I just kept on leveraging them. Now I do construction, all kinds of stuff, and I'm in mortgages. And he's like, oh, I totally want to do that, right? But I think in time. And so immediately go into loan officer mode. I'm like, well, I can tell you got a job, right? How much are you making a year? He's like, I'm making like 40 grand a year. Okay, cool. All right. How much money you got for down payment? He's like, I don't got enough. I got 10 grand. I'm like, okay, that's plenty. What's your credit score? It's not good enough. I need to get it up 640. I'm like, you've checked every box, right? Come into the office on Monday. We're going to get you pre-approved. And the story kind of like revolved around also like my oldest son, I only had him at that time, and he was playing in the yard, and he's like, yeah, I got a son as well, and I kind of want to create like something, form a legacy. And I started talking about it's called multi-generational wealth, right? You're creating money for him to pass on. Yeah. And not only the benefit of that monetary piece, but he's going to get so many ancillary benefits because he's going to see his father legitimately running a business, because when you own a property, that's what it is. You're gonna, accounting, marketing, maintenance. Oh, yeah. Right. You learn all these things, and I saw it in my own son as he started in school, and he was able to kind of engineer things with his mind. Like, he was problem solving, at a very, very young age. And I told him, that's the benefit of this, right? Oh. So he's like, cool, let's do it. So got him in the office, and he found something on the west side, bought a 4-flat for $300,000, and because of the credit that we put in, because we train that, and your prorations and all these little pieces, he bought that 4-flat for $300,000 with $5,000 total.
Unbelievable.
Yeah. So the guy, I got $10,000. I got my $40,000 a year job. I probably can't do this, but get him retrained. No, dude, I totally could do this, And now he's living in one, right? Renting out the other three. The other three pay for the mortgage, so he has no housing payment, right? And the next step is don't go blow it. You got extra $800 a month, right? Because you don't have that housing expense. You save that. You train your budget, right? Because now you're saving for your next property. Right.
Absolutely.
And then I see it all the time where people become really good at budgeting, and then they save money, and then they stop doing everything. Just starts to click. I don't need to go out 4 nights a week. Why am I just blowing my money on this, then the other? I should be creating wealth. And part of my training process is you got to read 2 books, and it's The Rich Dad, Poor Dad, and The Millionaire Next Door. And that is your basis. And then what it finds people after they read those books, man, I love books like this, man. And they start diving into other books, right? And you just start, you start your personal and professional development, right? On top of, your financial,
wealth building.
Wealth building.
Isn't that unbelievable? I mean, just all the other benefits that just come from investing in real estate that no one thinks about. Mm-hmm. It's not just cash. I mean, it's all of the other. What you talked about here earlier. Mm-hmm. It's personal growth, long-term retirement, comfort, security. So no, this is fantastic. This is exactly why I love having you here, because so many people have these sort of questions, and yes, you can find it on YouTube, you can find it on Google, but it's when you put it in this sort of, you're laying it all on the table and saying, this is how it is. Really, anyone can qualify for these programs.
Absolutely. And I just had this conversation last night. Somebody was asking me they were kind of talking about like success and stuff like that. I'm like, yeah. Both my parents never graduated high school, right? I'm the first one to go to college, very blue collar, right? No chance. I could have either said, victim or victor, right? I could have said very easily growing up, because I grew up in the inner city of Chicago, right? And I would say probably a great percentage of my grammar school colleagues could be doing time right now, for sure. A decent percentage of my high school friends, right? So I could have easily gone, down that path and mm-hmm. not been, what I believe is,
successful.
A trying individual, both professionally, personally, and with my family. But anybody can do it, right? There's a billion books on the internet that tell you how to do it, and that you can do it. It's just that you got to believe it, right? And you got to go after it, and you got to be committed to it. And it's a work in progress always. But go back to I didn't have a foundation. I wasn't taught this. And there's certain kids that if you do this and you have children and they see this, you're giving them such a leg up, right? Because those kids, I ran into those kids in college, and they were faster at marketing. They're faster at accounting. They're
yeah.
because they were born into business, and just buying one building or having a couple of buildings is that just that little bit. Not talking like, there's certain kids that like their parents are all business and they know all business 100%, and they're like they crush it in those academic circles. These are just like, I would see first generation immigrants, whose parents bought some buildings, and they were, first ones to go to college as well, but they got it. Like, I mean, everything came just so easy for them because they understood like the fundamentals behind it. And so that's part of the, not only creating generational wealth, multi-generational wealth, but giving your kids some, added ancillary things for engineering, just get the mind problem solving.
Absolutely. Yeah, that makes a lot of sense. Ancillary. That was it.
Yeah.
That was the word. Okay. Okay, now one last point, or because I think anyone who's hearing this, they're pumped. They want to, get the show on the road. How long does it take to actually get qualified? They call you up, they set up an appointment. How long can they expect to be? Okay.
Yeah.
Well, how long can they expect to be at that meeting with you? Is it just is it even at your office, or is it online?
We do it. It's really what's the most comfortable and convenient for people, right? You don't have to come in and sit down with me. You can. You're more than welcome to. You want to do it on a phone call. You want to do it on a Zoom call. It's very difficult on email because the answers sometimes create more questions, and so the very least is a phone call. Because I definitely love to like nowadays with Zoom, because I can see when somebody's thinking, and if it's that they're saying yes but they're not getting it, I can see it on their face. I go, let me try. I'm a really good.
You got high emotional intelligence.
Well, I have a lot of analogies, and so if something doesn't click one way, I can explain it a different way, and if that doesn't work, I explain it a third way to get that aha or the nodding. Right? Communication is a three-way thing. Right? I got to give you information, you got to acknowledge it, but then you also got to tell me that you get it. Right?
Right. So
if I say something to you and you're just like a deer in headlights, we're not communicating. Right. So I have to get that verbal kind of, whether it's over the phone, like that makes sense, or I see it, the nodding, right? Something that is telling me like where I'm going is not being like completely glazed over. Right. So whatever way's easiest. I mean, in person, it's super easy because I can tell, body language and, nodding or verbal, nonverbal cues. Over the phone, still pretty well. And then I back it up with some stuff in print, so that way you're getting it multiple times and we're driving it in.
So do they have to bring their pay stubs, their tax returns on that first meeting?
It's a financial analysis.
Okay.
Right? So we're asking you questions, right? And I always tell people it's like it's like going in the doctor, right? People are like, I want to get proof. Just pre-proof me. Well, do you just call up your doctor and say, prescribe me drugs? No. So
some try,
yeah, and they do. Actually, I take that back. That's why we have the opioid crisis. But
right.
So you got to come in. We got to check underneath the hood. That's the financial analysis, and then we kind of we start going into what's your goals? What do you want to accomplish? And then we start creating the roadmap. That's how it has to happen. Any shortcut, is going to manifest itself somewhere down the road.
Set up a solid foundation from the beginning.
It's the biggest cliche in the world of why it just doesn't it doesn't sink in for a lot of people, and that's because I want to push an easy button. I want all of these things given to me. Well, what happens if your house is built on a foundation that is compromised, right?
It's a cliche, but it you know what? It's so true. What else?
It's like a fundamental principle in every aspect of your life, not just financing or real estate, like everything.
Well, Ryan, I want to say this has been great. We've learned so much today that and getting a nice refresher. Before we sign off here, how are the interest rates right now?
I will tell people that this is the closest thing to free money you're ever going to get, right? So I'm going to use a number right now. So interest rates, let's say they're 3%, right? And they vary on different programs, but generally all right around there. So if the interest rate is 3%, the interest is tax deductible, right? Principal you're always paying back, so that's not tax. You don't get to write off, paying back principal, but interest is tax deductible. And if we use an example, right, of somebody making 40 to 60, 80 to 100, I'll use the statement that Uncle Sam has his hand in your pocket about a third of that, right? So if if my gross, I'm taking home about 66% of that after taxes, right? So I just flip that equation. So that means, now that I have this property, I can write off, a bunch of stuff, and using that same third equation, I'm going to get that percentage back, right? So if the interest rate is 3%, a third of it is tax deductible. That makes the net effective interest rate 2%, right? There's this thing called inflation, that varies from time to time, anywhere from 1% to 2%. Let's say it's 1%. It's probably going to be a little bit higher because rates stay low like this, not very often for a very long period of time. So let's say 1%. The effective interest rate is 1%. Pretty close to free money. If you Google long-term winners of, or just winners of inflation, because it's something that's constant out there, it just varies from time to time, it'll come up with holders of long-term fixed debt.
Real estate.
Mortgages.
Right. Or mortgages, yeah.
Mortgages and real estate, right?
Yeah.
So long-term fixed debt.
Sure.
Because inflation is going up, my rate has stayed constant.
Correct.
So winners of inflation, long-term fixed debt.
That's fantastic. Another great reason why, real estate is just such a win, and why it creates so many, it creates long-term wealth. And, I don't want to keep saying cliches, but,
I do want to go through one. Yeah. Like what's the old phrase? Like, landlords get rich while they're sleeping.
Yeah.
And I want to have this, not for right now, but I want to get a copy of this and put this out there. So I'm going to use this one piece because I know it's coming,
okay.
Right? So interest rates, and we've talked about this before. Interest rates and values have an inverse relationship or opposite relationship. So when prices are high, interest rates are typically low, but they switch, right? And what happens, especially with this is a piece that I give to all my multifamily developers and first-time buyers and all that stuff, because there's going to be a switch, and don't be afraid. That's opportunity, right? So when the rates shoot up and prices go down, what happened in 2007 and 2008, is that all these people that had long-term fixed debt, right, and had these properties and had, they went underwater in equity, right? But the mentality is stay in it because it's a long-term play. They were all petrified. They all, bailed on their mortgage. They all went into foreclosure, and they perpetuated the downward trend of real estate values. Okay, and there weren't enough people saying you're in a 30-year fixed mortgage. You got people paying your mortgage. Just hang on to the place. It's going to change because that's what it does. It goes up and to the right, but it doesn't go in a straight line. It goes up and goes down.
Sure.
Right. So I had a friend that was in that same situation and was about to go bankrupt, and I was like, you should be doubling down right now. You should be dollar cost averaging your properties. You should be buying them more right now because the prices that you bought, right? If you buy a bunch more here, you've averaged them, right? And so when it goes down and up again, your cost basis from these ones has gone down to here, and now you've got more wealth, and it's a long-term play, right? Because it will do this. It will do this. So don't be scared. There weren't enough people like me explaining this to people. Even seasoned, real estate people were like jumping ship, and what they should have been doing is, like I said, dollar cost averaging. That's what you do in your 401k. It's what your financial planner tells you to do with stocks. Why wouldn't you do it in real estate? And when you see it happen, which I've seen it on a large scale, right? These people that were buying, these, let's just say 300-400 unit buildings, that were smart about it and were continually buying stuff like in 2007, 2008, right? So they dollar cost averaged their buildings, right? Now, when the prices kept on rising.
So right now they're gold.
Yeah, they're gold, and they can, they can outbid you because they've dollar cost averages. They're they're paying like record dollar amounts for these buildings. Well, it's either one of two things: people that didn't dollar cost average and they're going to get their asses handed to them, or the people that did.
Yep.
The people that did, they're in it for the long term. You can't touch them.
Yeah.
So just more like, because there's going to be a downturn, right? There absolutely will be. That's an opportunity. It doesn't mean you shouldn't buy right now because you're getting it's still at low long-term fixed rates. When people are like, should I wait? Like, you can't time a market. You can't. What you do is you dollar cost average it, and that's how you are constantly in the market, and you're protected, you're insulated. If you try to time a market, you're probably going to be wrong 90% of the time.
Sure.
So absolutely buy now because the rates are low. When prices go down, buy that. Rates will be high. But then when rates go down again and prices go up, be able to refinance and bring that debt down. It's like retrading a stock at a higher value. So I think that's really important for people getting into this to understand that, and not be if that should happen, just to remember that you're in it for the long haul. It's a long-term play.
Perfect. What a great explanation.
I need to cut that out and
Yeah.
And send to people, because you're and the people that are like really good at this, they're always looking for that downturn because that's an opportunity to buy. They say that in the stock market. Why wouldn't it be the same in real estate? Why wouldn't it be the same in anything? Warren Buffett says, buy when people are fearful and be fearful when everybody's buying. Absolutely,
for sure. What excellent points, Ryan. And it's like every time I'm saying, okay, well, you know what? It's been great, and we're gonna, end it here. It's just something else clicks, with what you said. But the other thing, one last point is someone who just going back to the qualification process, right? Mm-hmm. Is because and I'm trying to nail this home here, take this home, is because someone who maybe they switch jobs, and but they've been working consistently, every year, but they've changed their jobs, 3 or 4 months ago. How would they get because I had that question. I had someone ask me, mm-hmm. I'm looking to switch my job. I've been at the other job about a year, but I want to go to this entirely new gig.
Field, right?
Yeah, field. How will that impact their qualifying?
It depends on how the income is, being, like given to them, right? So are they like a W-2 employee? Because if you go to, if I'm just out of college and I got a job and it's I'm like $50,000 a year, base salary, you're fine. Right?
Okay.
So if it's not that you're switching a job, it's like, what's your new compensation structure? Like, well, I'm just going to a brand new job. I was a W-2 employee, and now I'm going all commission. Well, you don't have a history of that, so that's what it's looking for, is consistency and history. And so either consistency is front thinking or rear thinking. So consistency is, I have a straight base salary. That's consistent, right? I'm a commission employee, and I've been doing it for 2 years. Consistency, right? So it's both frontward looking or rear looking, depending mm-hmm. on what type it is. So to answer the question, that doesn't prohibit you from getting financing, depending on the type of compensation you're getting.
Got it. Okay. Well, that helps answer that question for you, because I'm going to have her listen to the program. Okay. Well, Ryan, this time it's, thanks again. We had such a fun time. Is there anything else that I left out that you might want to add in right before we sign off?
Got to cover a lot of ground, and from a very high level. There's so many more details, and it's individualized. Okay. So there's no one size fits all, and that's the fun part of my job, is like I get to see all these great stories of people and find out where they're starting from, where they want to go, and there's something for you, right, to anybody. Like I said in an earlier piece, like, if you don't know where you're going, anywhere will take you there. If you want and know where you want to go, you can devise a plan. And if it's not today, it could be tomorrow, it could be a week from now, a month from now, a year from now. But taking the first step is the beginning to any journey.
Nice. So if anyone wants to get a hold of you, what's the best way to reach you?
My office number is 312-607-1111. And then my email address is ryan.cotter@movement.com.
Awesome. Ryan, thank you so much. It's been great. Thank you.
Awesome.
And if you like what you heard, please hit that like button, subscribe to the channel for more of this content. Take care.